Natural gas prices remained near a 9-week high on Friday, supported by a technical rebound and increased gas usage in electricity generation due to a decrease in wind power. The percentage of U.S. power generated by the wind was expected to decrease to 7% of the total, compared to a recent high of 17% in April. As a result, gas-fired power generation increased to approximately 43% during the week. Power generators burned more gas to compensate for the drop in wind power, resulting in less gas available for storage. The decrease in wind power and reduced gas exports from Canada contributed to the tighter supply of natural gas. Gas exports from Canada also declined due to wildfires in Alberta and other western provinces, causing a reduction in gas flowing to the United States. In the oil sector, U.S. energy firms reduced the number of oil rigs by 11 in a week, the largest decrease since September 2021. Additionally, 17 natural gas rigs were cut, marking the most substantial decline since June 2020. The combined oil and gas rig count dropped to 720, the lowest count since May 2022. This reduction in rig count could potentially impact future oil and gas production. Weather projections indicated that the weather in the U.S. lower 48 states would remain mostly near normal through June 3 for the light gas demand for the next 2 weeks. Nevertheless, the quantitative gas-weighted degree-day outlook for weeks 3 to 6 projected higher weekly temperature anomalies. Over the past 3 days, the forecast for week 6, which currently includes June 25 to July 1, increased by 2 degree days or 3% and is 10 degree days or 14% greater than normal. This suggests a strong temperature-dependent contribution to natural gas demand in June. On the positive side, we have the following factors contributing to a bullish outlook. Increased gas usage in electricity generation due to reduced wind power. Gas exports from Canada decline, exacerbating the tighter supply. U.S. oil and gas rig count drops significantly, potentially impacting future production. On the negative side, we have the following factors contributing to bearish pressure. Gas output remained at a record level of 101.4 billion cubic feet per day in May, matching April's monthly record. However, analysts forecasted a decline in U.S. gas demand, including exports, from 93 to 89.4 BCF per day the following week, before rising to 90.7 BCF per day in 2 weeks. Gas flows to the major U.S. LNG export plants decreased to an average of 12.9 BCF per day in May, compared to a record 14 BCF per day in April. Maintenance work at various LNG plants contributed to the lower gas flows. Nat gas hit its highest level since March 22 before running into resistance and retreating. Nonetheless, it remains on the bullish side of the nearest support at $2.60 and the daily pivot at $2.50, with the 50-day moving average underneath offering a certain amount of support. Its current chart pattern has put it in a position to test the next target level at $2.80. This could act like resistance on the first test. However, it's also a potential trigger point for an acceleration to the upside, with $3 as the next target, with the 100-day moving average above offering a strong resistance.